I want to move on here to another hot area of the market because this was all the rage last week. That's initial public offerings, IPOs. We've seen a whopping 66 companies go public this year. 7 more on tap to make their debuts this week. There's also Slack, may or may not be an IPO depending on your definition. That's set to go public Thursday via a direct listing. These stocks have gone parabolic. Look at these numbers. Beyond Meat's up more than 500%. Zoom and PagerDuty, CrowdStrike, all soaring. This is the Renaissance IPO ETF, more than doubles the performance of the S&P 500 in 2019. The one behind that ETF, Kathleen Smith of Renaissance, joins us now. You know what amazed me last week is you had 3 IPOs. We had Chewy, Fiverr, and CrowdStrike, all up more than 40% in the week, and all in completely different spaces. So you could say, oh, well, cybersecurity is hot, so that's why they're going up, or biotech is hot. But 3 completely different spaces here. What is this telling us right now?
Well, I think the important theme here is called growth. And investors are looking for growth companies in a slow-growing economy. And the Fed is helping matters by keeping interest rates low, because growth companies, a lot of their valuation is based upon future earnings, and the discount on future earnings is gives a higher present value with lower interest rates. So we are in a very positive environment for growth equities, which are a large part of the types of equities in the Renaissance IPO ETF.
But when you get these kinds of blow-ups, I think you're right, but if there's any slowdown in the growth outlook, these stocks are going to get hit rather notably, right?
There's no doubt about that, and the investors are expecting many of these stocks to beat expectations and to guide higher. So it's really important, and that was the problem we had with Snap way back when. That company overpromised and underdelivered. We need the companies to underpromise and overdeliver, and I think that can happen in even maybe in the slow growth economy. We're talking about technology, new inventions. We're talking about real growth, and even with Chewy's, which is a little more of a traditional company, it had a pretty high growth rate and the dominant player in online and e-commerce for pet supplies.
You and I talked about this in the beginning of the year in February, and when the market wasn't even open, and the concern was we had 200 companies ready to go public this year, and the concern was how are the market going to absorb all of this? Even if the market is doing okay, it's a lot to sort of push into the market, and you were saying they're going to keep the prices lower because there's so much competition. Yeah. Maybe you're right, but the aftermarket trading has been much better than anticipated. I guess the question is, where did we go wrong with the picture? It's doing a lot better than I would have thought in February.
Well, believe it or not, some of these companies, even though the valuations seem high, are being priced below their last rounds of financing. We knew that was the case with Pinterest.
Yeah.
So we've been seeing this sort of working itself out in the public market, taking out rounds in the private market to get deals done. So there is, and these stocks cannot be disconnected with all the other publicly traded peers. And the peers are at pretty high levels. So we're seeing the interest in growth and then high multiples already in the public marketplace. And underwriters are being somewhat cautious when they price these, which is why they're trading up so much, because they see they could be highly volatile. And so they don't want to have the stock break its IPO price early on. So some of the pricings are fairly reasonable when they come out. Now they have to work themselves.
I know you're largely in the fixed income space, but when you see these kinds of movements, 40% up in a week, 50% up in a week for a pet food company, essentially, let's be honest. As a fixed income person, what do you say to all of this?
Yeah, I mean, I think if you're going to have equity risk, I think you should have growth. So I'm not saying that I don't know these IPO stocks, but I think generally, whether it's China or other asset classes that are more growthy, I think I'm not a big fan of like the min-vol stocks or the low beta stocks, because I think if you want equities, you should have growth in your portfolio, and if you want fixed income because you want to be more defensive, you should own, products like IVOL, which are long bonds and long a hedge against the growth markets, because we make money when yields move higher in the back end, which is when these growth stocks do badly. So I think it's a good time for investors to diversify, but if you're going to have equities, have your growth stocks, whether they're thematic or China or IPO focused.
And of course, the good news, Chris, is eventually these IPOs find their way into the overall market for the most part. You already include, within weeks, all of the recent IPOs.
Well, and the big rebalance is happening at the end of this week for almost all the major indices. And they will absorb the very large ones. And that's why when we created our product, we wanted to make sure we had early the very large ones. When it comes to IPOs, the float is usually the weighting factor at the end. So they look like small companies when they're in big indices. But once they start to come out, they begin to become major factors. Like Uber will be a top holding in many of the ETFs by the end of this week.
Yeah, I mean, we're going to look at, this is the major month for rebalance is this in December. So you've got quarterly expiration coming up on Friday. You got month end after that with the Russell. A lot of the indices that the ETFs are tracking, especially the passive ETFs, which have the lion's share of equity ETF assets, are very well trafficked, and they have very strict and specific rules that allow for inclusion of securities. What's great about the IPO ETF and others like it is that they've built them with rules that allow them to add names earlier. There's a merger ARB ETF by Index IQ, things along those lines, where they can keep certain kinds of securities in their portfolio where a major index like MSCI, S&P, or FTSE might not be able to on their rule set. So to Kathleen's point, we are eager to see, we already, to subscribe to index methodology, which names do get added, from the hot new IPO space.
You can't but be impressed by how the activity this year has moved.
Yeah.
It's certainly not what I would have anticipated overall, but that's what makes the market, folks. And that does it for this week's ETF Edge. I'm Bob Pisani. My thanks to Kathy, Nancy, and Chris for joining us today. And thank you for watching. You can find all of our latest videos right here on our website, etfedge.cnbc.com. We'll see you next Monday, same time, same place. Have a good week.
Thanks, Bob.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.